back to The Best of Investing. I'm Edward Brown, your host, along with Mark Hunt, president of Pacific Private Money, and Robert Spinoza of RPM Mortgage. When we cut to the first commercial break, we asked this trivia question. Again, the theme is famous historical trials. What snack food was linked to the defense used by Dan White in his trial for the murder of Harvey Milk and George Moscone?
That would be the Twinkie defense.
The Twinkie defense.
Indeed.
It's correct.
That hits close to home here. That's San Francisco.
Hey, by the way, just wanted to give a quick little note here. One last thing for the Glen Ellen Inn. They just finished up updating the restaurant and cottages. Check them out at glenellen.com. They have very good food there and nice little places to stay. Okay, let's get right into email time here because, Robert, we got an interesting one for you. A lot of people, I'm sure, this being March, this question is apropos.
Okay.
I would like to refinance, but I haven't completed my tax return yet. What do I do?
Great. Okay, good question. So this is the time of year where obviously everybody is in the process, or most people are in the process of filing their tax returns, April 15th deadline. Some people will file on extension, but we're not going to talk about that right now. Let's focus on you're in process, and if you are a wager, meaning you get a W-2, you get a pay stub, and you're not qualifying on any bonus income or hourly wages that need to be averaged, and certainly if you're not self-employed, then what's going to happen is most lenders, by and large, are going to use the W-2 you got for 2013, along with your previous history, so 2011, 2012, and that will be fairly consistent in most cases. They'll qualify off that. Now, if you have a situation where you need to use the income that you earned in 2013 that will vary in some fashion from previous years, you're in a situation where the lender is looking to not only underwrite your tax return, which you may or may not have, but they're also going to pull a 4506T, which is the IRS request for transcript. And when they do that, if the IRS has not yet processed your return, it will come back with no record. So the bank making the loan is not certain that what you filed is actually what the IRS has received.
Yep.
So what you need to do if you're in this situation now, what I advise is that you get a stamped copy of the return. So you actually have to go through the inconvenience of bringing it to the IRS office, get a stamped copy, and then provide that to your lender. And then what's going to happen is the lender is going to know that this was authenticated in receipt by the IRS, and they will go ahead and they will review that. Now, if you have a wild fluctuation in income upward, you can expect your lender to push back a little bit on that if they can't verify it with the IRS. Okay? So in those situations, consult your loan advisor. If you have additional questions, certainly let me know. I'm happy to walk you through any nuances of the way it may be for you. But know that this is just part of the time of year, and until the lender has both the return and the 4506T executed, they're looking to do a little extra due diligence to make sure what you're submitting to them is what you're submitting to the IRS as well.
Fair enough.
Yeah, that's how it works.
Yeah, in this day of TurboTax.
Right, so
you
good
have two
point.
returns, one for the IRS and one for your bank. Hey, I made all this money last year.
No, I didn't.
How come it's not in your bank?
So yeah, that's how you get around that. If you file with your TurboTax or you're into it or whatever it may be, then the lender doesn't have a record. So you want to avoid that at this time of year.
Okay. Fair enough. How do people get a hold of you?
They can go on to the Best of Investing website. My bio is there. My contact info is there. But certainly, alternatively, you can call 415-367-5959. And I'm with RPM Mortgage. I work out of the Mill Valley office, so you can look us up online as well.
And I've referred a couple of people to you because you were very
Happy to help.
sharp.
Yeah, absolutely.
Okay.
And sharp dressed.
Thank you.
Yeah, that's true. I got to say, out of the three of us, he is definitely the most handsome of us all. Okay. Mark, we have an email here from you from a listener who says, I've heard you mention that your fund is paying over 8%, but what are my risks of investing in it?
You know, it's funny. So that person is writing, asking about the mortgage pool fund that those of you who've heard us before may have heard us talk about on this show over the last year. So at Pacific Private Money, we have a mortgage pool fund we call the Pacific Private Money Fund, and it is essentially a lending device that we use to make loans to real estate investors. That fund is funded by private individuals who contribute to their savings or IRA accounts. They invest in the fund. We sell shares in the fund, and we loan money out to real estate investors from that. And so we've got right now our average loan to value in the fund is at 63% loan to value.
Nice.
So the
Very
fund
conservative.
it's a fairly conservative loan to value when you consider that banks for years have been making 80% loans.
Right.
Everybody knows about if
Right.
you're going to go buy a home, you can get an 80% loan.
That's considered safe.
Right, and,
Yeah.
and you put in 20% down. That's your skin in the game. That's the equity slice.
Right.
The bank has that 20% protective equity. Well, in private lending, which is sometimes also referred to as hard money lending, when we're making loans to usually non-owner occupied real estate in California, typically purchased to remodel and flip or purchased to hold for rental income. That's typically the type of property we're lending against. What's different about our loans is that we typically don't go higher than 70%. That's our maximum, generally speaking. There are exceptions.
Well, and also this is a either rising or
Right.
flat, worst case scenario market. We're not in a declining market,
Right.
so that's even more conservative.
Mark, I was going to ask you: is everything in the fund residential, or is there any commercial in there?
There's some commercial, and
Okay.
we usually small commercial. So
Okay.
it's not
Like a
big,
mixed use
It's
sort
not,
of-
it's not a $1 million
Right.
loan. It's a $250,000 loan on a mixed use or a commercial
Right.
building. We've got one loan in there that's essentially the tenant. It's an owner user
Right.
for that. So they're looking forward to getting an SBA loan, and that's how they intend to pay off this loan
Right.
within a year. But meanwhile, they're using our loan as a bridge loan. So the question is so how safe is that investment? Well, for example, I got a phone call this week where a woman calls and says, "Well, how safe is it?" Well, I said, "Well, I start responding to her, and she said, no. I asked you a simple question. I said, how safe is it?" And I knew right away I was talking to someone who really is looking for some kind of FDIC insured.
Right.
Your money's guaranteed against loss. There are no guarantees against loss in most investing unless you invest in certain types of government bonds, right? Or if you
Okay,
put your
but you
money
can
in a
earn
bank CD, right?
Fraction of a percent.
So-
But you also have interest rate risk with those because if
Sure.
you invest in a 30-year bond
Erodes the
today,
value, inflation erodes the value.
Right.
well, not
Yeah.
only that, but the thing is, if interest rates start going up,
Yeah.
the price of that bond is going to plummet.
Yep.
And the only way that you're guaranteed is if you hold the bond until interest rates either drop or you keep it for the whole 30 years.
Yeah.
So, you're guaranteed. In that case, the government will guarantee to print more money.
Right. So principal guarantee is a big issue in investing. Obviously, the older you get, the more concerned you are with preservation of capital or principal protection. Well, the stock market offers none. We know
Right.
that you can lose everything, and many people do when a stock goes bust. Of course, unless you're in mutual funds, but then you're subject to the swings of yield. What are you making year over year? And we know what's happened over the last 10 years in the market.
And
So-
I remember in 1987, some mutual funds dropped 25% overnight.
So what we're offering is not a publicly traded investment vehicle. It's what's considered an alternative investment. It includes things like, real estate's an alternative
Right.
investment. It's not a liquid investment. And mortgage pool funds or trust deed investing, which is also a form of private lending, all of these are referred to as alternative investments. People oftentimes through their self-directed IRA will invest in these types of generally high-yielding opportunities. But the safety and security features of a mortgage pool fund like the Pacific Private Money Fund are the fact that we make loans with a lot of protective equity, much more than Wells Fargo, Bank of America, Chase, or Citibank do when they make a loan. Our loans are identical in terms of the documents we use. The note, the deed of trust are identical to what the banks use. Our underwriting and the disclosures, all of that are, the underwriting's not identical, the disclosures are identical. Our underwriting is different because we look at
Focus
different
is different,
factors.
right.
The focus is different, right? We're focusing on different variables in the bank. The banks look at numbers. We look beyond the numbers to the safety and or basically the exit strategy
Right.
for the person who's borrowing the money, because our loans tend to be short term. So again, I apologize for making this a long-winded investment, a long-winded answer to a simple question: how safe is it? We have protective equity, so the market would really have to tank again, like it did in 2008 and 2009. What's the likelihood of that? I don't
think
know.
it's very small.
I think it's very small, given that the air has largely been let out
That's
of
right.
the inflated
Yeah.
prices
But
already.
also it has to. I think it has to do more than that because even when prices plummet, not everybody just walks away from the property. They
Right.
think, I want to hold on to this because the market's going to recover.
But
They'll continue to pay.
I agree with you on that, and I also agree now that we've seen in recent past, and people are kicking themselves now when they watch Blackstone pick up all of this property and put it back on the market as rentals. So if we had a downturn like that, one has to wonder, would these investments become more appealing, and would people be looking for those financial vehicles to get into them more than they are now, with prices a bit higher?
So the way we cover, the safety features in a fund like ours is very few of the loans in the fund are longer than 12 months. Many of them get paid off within 4 to 6 months. So the real estate market doesn't generally crater in a short. In fact, it's never cratered in a 6-month period.
Right.
It can go down. I mean, look how many years it actually took for the prices to go from the peak, which was generally considered right around 2007, somewhere.
Probably early 7, yeah.
And the bottom of the market, the initial bottom, some argue maybe we had a double dip, but the initial bottom was right around 2010. So we're talking about a 3-year period
And
where prices went down.
you don't do 30-year loans.
Well, I also wanted to say one thing about the person that called you, and that is you have to be careful when you are asking how safe something is and you are relating it to something that it's not related to. So
Right.
if you're saying real estate and you're thinking about your primary home and your first mortgage on a primary home, that is a world removed from a private money loan for an investment purpose. It's not the same thing, even though it's real estate.
Someone
It's
also,
not the same
he's not
thing.
lending in Detroit or Cleveland.
Right.
He's lending in the Bay Area. And
So the net result of the question is really what the way I want to answer it is we take the fiduciary responsibility that we have with our shareholders very, very seriously, which is why the weighted average loan to value in our fund is presently 63%, and we don't ever expect it to even hit 70 ever. Number one. Number two is that we're producing yields between 8 and 9%. We're right at about 8.5 right now, and I don't know of any other investment, and I'm familiar with all the other companies in California that are doing similar products, and I don't know of any other mortgage pool investment opportunity right now that's paying 8.5% that has the safety and security features that we have with our Bay Area weighted mortgage pool fund. And so
don't keep us in
so
suspenders.
for more information, again, this is not something I'm trying to beat people over the head with and say, oh, you really need to invest in this, but you really need to investigate the opportunity. I think if you want to boost the savings you're earning in your portfolio, your savings portfolio, give us a call. Phone number is 415-883-2150. That's the phone number for Pacific Private Money, 415-883-2150. Or if you want to visit our fund's website, you can find it at the pacificmoneyfund.com. Sorry, I said it's just pacificmoneyfund.com.
Very good. Okay, we're going to cut to, in fact, when we come back, I want you to get into the deal of the week because you won't believe the kind of deals that Mark gets. The question, I'm sure people are listening if they're listening for the first time.
Tell us about a loan.
Yeah, I mean, how are you
That
getting
is
8.5%? Okay, and why are these people borrowing at that rate? Okay, so here is the
Because they're crazy.
They're crazy to make money.
They are, absolutely.
Yeah,
crazy about making money in real estate.
They're going to borrow at one rate from you, but they're going to make a lot more than that.
Heck
So.
yeah.
Okay, so here is the second commercial break trivia question. Again, the theme is famous historical trials, and I think these questions are getting just a little bit harder than the
Oh
first
boy.
one. Which one of the founding fathers was an attorney for the defense of British soldiers for the Boston Massacre? The first 3 callers, put your hand down, Ron.
I know
The
this.
first 3 callers, and I'll tell you why I know this. The first 3 callers with the correct answer win a free 3-day 2-night stay at the Lighthouse Resort. Their website is lighthouse4fun.com. Call 888-912-1190. That's 888-912-1190 to answer this question. Which one of the founding fathers was an attorney for the defense of British soldiers for the Boston Massacre? And the Boston Massacre, by the way, only 5 people died, so it was a massacre, but it was a small massacre.
If you're one of the 5, it was
Yeah, it was a big massacre.
Really good marketing on that name there.
Yeah, thank you. Okay. Don't
Wait,
touch.
you didn't come up with the Boston Massacre.
Yeah. Don't touch.
Yeah.
Don't touch that dial. The best of investing. We'll be right back.
Thank you.
And the only reason I know
The
this.
Boston murder. Let's call it the Boston Massacre.
Yeah.
People gunned down children, women,
Right.
appendages flying
Appendage.
everywhere.
Bloodbath.
It's a bloodbath.
Appendages flying. You're funny.
Oh, God.
And the only reason I know this is because I saw the series. Is that? But you're a smart guy. You probably knew it.
I read that book,
Oh, really?
John Adams. It was really that guy was a fascinating guy.
He was.
Yeah.
Well, he doesn't look like it when you see him
Yeah,
in
when you
presidential things.
right.
But,
And it was overshadowed by Jefferson in just about
Yeah.
everything.
Yeah.
But that book
Very
strikes
smart.
a lot of strikes a
Paul
lot of-
Giamatti did a very nice job.
Oh, I did. I never
Oh,
saw
in
that.
the
That's right.
HBO
Yeah,
series.
I
Yeah.
didn't see that. I wanted to. I remember he played that. Yeah.
Yeah, I like Paul Giamatti's
Oh,
acting.
this scared me. I'm all, why is this? I'm all March 8th, but I'm going, why are there repeats? But there aren't. There's 2013. Okay.
March 8th. Wait, it's the 6th today.
Yeah.
I have a series of articles
Okay.
on affordability. Maybe we cover that in the next show because we can probably
Yeah,
talk
we
a
have
bit
more
about.
time in the next
Yeah.
one. Yeah. Okay.
And then I just have some other weird stuff on
We like
Oh,
weird
by
stuff.
the way, Julie, she won't be with us anymore.
Julie.
Kennedy.
Kennedy.
Yeah.
Okay.
Just as an FYI.
Any particular reason? I mean, I know sometimes
Just she and
it's
her
hard.
partner just kind of looking at other. They have a
It's
marketing
tough. It
budget.
doesn't, I mean, we've seen how, Rob's been like really one of the few co-hosts that have stuck it out long enough to where it might actually, start to really,
Yeah. Well, it's also how you present it to marketing to
Yeah.
the public. If you never mention anything,
Right.
and like I kept
The
asking
critical
people
mass is
to
important.
give me stuff to put on the BOI,
Yeah.
and they haven't done it, and I'm not
Right.
going to force the
Right,
issue.
right.
Yeah, it's how you.
Well,
present
one of the
it.
other things about it for me that's valuable is the fact that you can then do all of your social media stuff and say you're a
Credibility.
co-host.
Correct. And the thing
Great.
is, I mean,
It's like your resume.
who am I
you
going
know?
to refer people to?
Right. Right.
And then the thing is,
No, I like.
yeah, I
we've
mean,
talked.
like here, like the two of you guys, Okay.
Sweet.
Alrighty. I have one other quick little announcement.
If you need a real estate agent, though, I'll keep my mind.
Yeah, I mean,
on
it'd be
that
nice to
because
get somebody in,
Yeah.
because that doesn't.
In
conflict
fact,
with
there was
everything.
one the other I was thinking of, and
Somebody who's,
Rick
Yeah.
Warner was good. He was
Rick
did
was
good
very
ra- did good radio.
Yeah.
Who else do we have?
I don't know him well though. Yeah, I don't know him.
Yeah, but he's up there.
Is it right?
I mean, it's great if you can get somebody close enough here who can
Right.
just
Just
come
pop
in
in.
and pop
Yeah.
in. Okay, ready?
Yep.
Burping, excuse me. I got the burp.
Good radio.
You got the burp. Yeah, good radio. Drinks all around. Here we go. Welcome back to the Best of Investing. I'm Edward Brown, your host, along with Mark Hahn and Rob Spinoza. When we cut to the second commercial break, we asked this trivia question. Again, the theme is famous historical trials. Which one of the founding fathers was an attorney for the defense of British soldiers for the Boston Massacre? And Mark,
Nope, I don't know that one.
John Adams.
John Adams, that is correct. And what did you say about marketing? That instead of calling it the Boston
Well, it's
Murder,
Yeah,
call
it's
it
the
Boston
Boston
Massacre.
Massacre. Make it sound like hundreds of people.
hundreds of
were blown
people,
away.
yes.
Appendages flying everywhere.
Yeah. A little disgusting on that. Quick little promotion here. The RussianRiverAdventures.com. Fun for all ages. And now a few months ago, our family went on a rafting trip on the Russian River,
Yeah.
and we had a blast. No helmets are required, so it's you can take the little kids on
Thank
there.
God.
Yeah, I've done those before. But we're actually going to have some company.
But they do want you to wear a life preserver.
Yeah, oh yeah, always got to do that.
Suppose that's a good idea.
But it's not a long drive because the Russian River isn't that far.
Colonel?
Yeah, so
Okay.
yeah, so you don't
It's
have
right
to,
off 101. Yeah, just a few miles.
exactly. You don't have to go like all the way to Washington State or anything.
It's a lot of fun if you haven't done it before.
It is, and you can do either a half day or a full day. It's inflatable, and they're actually comfortable rafts.
Yay.
Me with my back problem and all that. So check them out at RussianRiverAdventures.com. Very much
Cool.
very fun. Okay. So Mark, before we cut to the break, I told people that you were going to tell us about the deal of the week because again, your fund is paying over 8%. People are probably wondering how can you do that. Again, we got into the risks, but why are these people borrowing from you? Give us an example.
Well, instead of a specific deal, because you caught me a little bit unprepared, Edward, there. But what I'm going to do is to give you a couple of examples of deals we've done recently that
Fair enough.
as opposed to the deal next week. I promise deal of the week. So essentially the loans that we're making are usually to guys that are buying, fixing and flipping real estate. Okay, so no secret that that's been very, very popular since the market bottomed out around 2010 and 11. Now, at Pacific, we've been writing loans since 2008, so we started making loans to people early as the market was beginning to dip, and even though the market was still going down, our foreclosure record after over 600 loans is only 2 loans. So we're talking about almost an insignificant foreclosure rate, and both of those foreclosures, the lender who ended up with the property was very happy to have that property, so there was no money loss. So again, just to give you an idea, these people can and have lost money in prior cycles, making crazy seconds or high LTV seconds,
yeah.
right, on which was hard money used to be. And while we do sometimes make a second, 95% of the funding we do are first position mortgages, and most of those are first position purchase mortgages. So we're really serving the community of real estate investors who want to buy real estate for the purpose of making a profit or holding it for rental income. And they've gone to the banks, and the banks either aren't making those loans anymore, which is typically the case, or because of the way the market is right now, you generally, to get a good deal, you have to make a very aggressive offer with a fast close. So banks are generally not set up to close, in less than 21 days, and some can't even accommodate 21 days. And many of the folks who come to us to borrow money are looking to close next Friday.
Right.
They've been in contract for a few days, and maybe they were going to go to their bank, and they abruptly found out that, sorry, we can't help you.
Well, they found out something like, we can't even get your appraisal ordered until we send out all these disclosures that are now required by law, and that's going to take a few days, and then you have to consent, and then we can order your appraisal.
And the seller is anxious to sell,
Right.
and this buyer is getting a smoking deal on the property.
So why would someone pay the kind of rates we're charging? And we generally charge, our average loan is 10%. So some are a little bit less, some are a little bit more, but generally speaking, 10% is a very typical cost of a private money loan, also known as a hard money loan, in the San Francisco Bay Area. These are generally short-term loans, usually 6 months, 12 months, sometimes 24 or 36 months. But by and large, the strongest demand for this short-term private capital that is not available through the banks in today's market. And we don't know if and when the banks will come back and try to compete in this particular market. I think the private money market has really developed over the last several years to provide short-term capital to real estate investors, and the cost is what the cost is.
Right.
Real estate investors just factor that into their budget. They know that if they're going to get a hard money loan, they're going to borrow $100,000 to buy a property in the East Bay that they want to fix and flip. It's going to cost them anywhere from 3 to 5 points. 1 point equals 1%.
Right.
So let's just say we usually charge 3, so it would be $3,000 in quote origination points, maybe $1,000 for documentation and processing, and they're going to pay 10% for that money for as long as they're using it. And if they can fix and flip the property in 3 months or 6 months, or maybe it takes them 8 months, however long that is, that financing cost is going to be built in, or should be built into that budget. And we usually make sure it is.
But again, I want to say this because my mic won't pick it up anyway. I want to say I want to say this because it's very different than residential lending in the sense that with residential lending, well, Edward, why don't you go ahead and finish my point?
Well, with residential lending, go ahead.
Is that better?
Yeah.
Okay. So with residential lending, I think if you are listening to the show and you're thinking, well, I have a 30-year fixed rate loan on my house for 3.75%, and Mark is telling me I can get a loan for 10%. Oh my God, it's not the same thing. It's a solution-based lending, whereas when you're borrowing against your primary home to live there for a long time, that's not what an investor is doing there. They are looking at that like a financial equation. They're factoring in the cost, they're factoring in the debt service, they're factoring in the remodel cost, and then the exit strategy, what they're going to do. Are they going to sell it down the road and at what price? And that's the difference, and you have to view it in that light.
And could you, Mark, can you give us an example of something that you've actually recently done? Because you gave us like the typical situation.
Well, actually, you know what?
These
I wanted to actually continue on in just a different realm. I talked about the type of loans that we're generally doing, but the other question is well, aren't you making loans to borrowers with ruined credit? And the answer to that is not always.
Right.
We have
right.
a lot of borrowers with 700 plus FICOs. In fact, we just funded a deal the other day. It was a purchase money loan in San Francisco. They were paying about $1 million for this property, and of course, fixers in San Francisco, $1 million is actually a bargain, oftentimes. And so we provided them with a $700,000 loan. We were able to close it in 10 days, and they paid a 9.9% rate, paid 2.5 points. The FICO score was close to 800 for the primary borrower. And again, the reason they were doing this was because they knew that we could close within 10 days, and they can't get bank financing. So it's not like they're grudgingly coming to us. I mean,
you found a solution.
there isn't a market really between our 10% private money and the 5%. Let's call it 5% bank money.
Right.
There's really nothing in between right now, and the reason is that just happens. That 5-point gap actually is historically speaking the average spread between bank financing cost, the bank rate, and hard money rates. So consider that prime, not that long ago was between 6 and 8%, and hard money was between 12 and 13%. So
well,
hard
here's
money
the other
prices
thing.
have gone down a bit.
It's amazing how many people who actually can go to the bank, they just won't because of all the red tape. Please, Mr. Jones, explain to me why there's a $300 deposit.
Right.
I'm going for a $3 million loan, and you're
Right.
asking me why there's a $300 deposit? They just don't want to deal with it.
Right. So people come to me who aren't familiar with what we do, but and it's usually like someone who's considering making an investment in our fund. They'll go, "Oh yeah, I've heard about what you guys do. You make seconds to people who are in trouble." Well, no, that here's the thing. Hard money that most people remember from 10, 15, 20 years ago, that business model is gone.
Right.
It went the way of subprime. It doesn't
yeah.
exist anymore. It was regulated out of business. We're not allowed to do predatory seconds to homeowners. We can't. It's illegal to do that today. Dodd-Frank killed that business model. It cannot be. You can't legally make that loan anymore.
I'll also bring up 2 points from the residential perspective to kind of follow up on what Edward said, but also on your scenario where you have a $700,000 loan and you're looking to remodel the place, I believe you said.
Right.
Okay. So that would be considered a jumbo loan, number one. And number two is that would be an investment property, a non-owner occupied jumbo loan. And those are not that easy to come by in the residential environment right now. Even though we've seen a lot of jumbo product come back, there are not a whole lot of investors in that game. And there is a premium for those loans.
Yeah. How much?
So
what rate are we talking about?
well, I would think
6%?
you're getting there.
Yeah.
You're getting there with some investors. I mean, you may find it more aggressive than that. But if that property needs to be remodeled and is not in condition to even appraise, the question is moot because you're not going to get a residential mortgage lender to make a jumbo loan with anything other than a stellar appraisal. So there you go. I mean, you've got to go that route.
And does that bank want their money back in 6 to 8 months?
Yeah, that's the other thing.
No, right.
Defeasance. That's sophisticated talk there.
Avoid that at all costs.
Yeah.
Just sounds bad.
Yeah.
Listen, I have a credit default swap loan on one of my properties, and when interest rates went down, the prepayment penalty was going to be $200,000. Oh, scary.
Yeah.
Thank you, Mr. Banker. Okay, so here is our third and final trivia question. Again, the theme is famous historical trials. Which famous historical figure went on trial for heresy in the year 1431? The first three callers with the correct answer, and it was not Bill Clinton. The first three callers with the correct answer win a free 3-day, 2-night stay at the Lighthouse Resort. Their website is lighthouse4fun.com. Call 888-912-1190. That's 888-912-1190 to answer this question. Which famous historical figure went on trial for heresy in the year 1431? Make sure to include, we're going to party like it's 1431. Prince, right? Make sure to include your name, your email address, speak slowly, spell out your email one letter at a time. When the best of investing comes back, we have a couple of interesting articles and some thoughts for the day.
That's a good one. 1431.
We're going to party like it's 1431.
No idea.
I was going to say Christopher Columbus, but that would have been too soon because he would have been
how much minutes we got here? That's 20, 6, 30. This will be a short one. Friends. 7 minutes, 17 seconds. Anything you guys want to cover specifically?
7 minutes, 17 seconds.
Yeah, it's a short one.
Yeah. Well, Rob's got some good articles.
I got Fannie Mae swings to record-breaking profit.
So I've got some good stuff too, but I mean, again, for some it's hard to get. It's just, I hogged the last segment since Rob.
Number of Bay Area homes with underwater mortgages tumbles. You want to go over? Yeah, you know what? Let's talk about that because I was going to piggyback on something you said about credit.
Okay.
What I've noticed recently, and we can tie it to this topic, which is number of homes with underwater mortgages tumbles. What I've seen is that the average FICO of my borrower is going down.
Wow.
And I think that's because equity is going up and it's bringing people back into the fold that otherwise were not eligible because of equity position in the last few years.
Yeah.
So now, like, let's say you were at, you were like, oh, I'm underwater, or I think I'm underwater, and I also have a shaky FICO.
Yeah.
Now, all you've got is the shaky FICO because you might be at 75% LTV now, 80% LTV.
Oh, very interesting.
So I think, and I
Very
got a call
interesting.
from a credit repair company, soliciting our business. I started talking to the guy, and I said, "Hey, are you seeing this?" He's like, "Yeah, we are actually seeing it." So I don't know if he was.
Yeah, let's bring that up. That is interesting. Okay, here
So
we go.
maybe you can cover some of the points about the actual negative equity.
Am I on?
You're
You
on
love
now.
me.
You're on
You
now,
really
darling.
love me. Wasn't that?
What do you want?
Sally
to
Field.
Southfield.
You know what?
Just
That's what I gotta do.
percentages,
I gotta do.
Okay.
I gotta do a
I'll
trivia.
definitely check it.
Sally Field. I got a whole bunch of good questions from Sally Field, but that'll be for another time. Okay.
I'll start studying now.
Yes, and away we go. Welcome back to The Best of Investing. I'm Edward Brown, your host, along with Mark Hahn and Rob Spinoza. When we got to the third final commercial break, we asked this trivia question again. The theme is famous historical trials. What famous historical figure went on trial for heresy in 1431?
Can you give me a nationality maybe or something?
It's a woman.
Joan of Arc.
Joan of Arc.
Ah!
That's why I said historical figure.
Good job.
Ah!
Very good.
I think I was 3 for 3 today.
Yeah, well, yeah, with a little help from our friends.
Ah.
Okay, that's okay. I'm teasing you. Okay, Rob, you have an interesting article that you were starting to share with us off air. Bring it on air.
Well, Mark prompted sort of an idea I had that was worthy of discussion, I think, and I have an article to support it. But we were talking about FICO scores and credit and borrowers and their FICO scores, what sort of eligibility that brings into play. What I've noticed recently, though, I find extremely curious, and that is the average FICO score of my borrower is actually going a bit down. And you would think in this environment where the restrictions are ultra restrictive, that you would only see it going up.
Or just with the economy going up, you would think.
Right.
In fact, I heard that the average FICO or that the average loan closed, the borrower had a FICO score of, and I heard like 740 at one point,
Okay.
6 months ago.
Okay.
You're saying that's trending back down.
I-
At least anecdotally, you're seeing lower scores.
I see that in my pipeline. Hey, maybe
Yeah,
that's
that's
just
surprising.
me.
No, but
No.
well, are the banks loosening up and
Well,
going to lower ones?
Yeah, that's a great question. So I think what's happening, this is me, and I've talked about some other people, talked about it with other people, and they've also said that they're seeing similar things. What I think is happening is the increase in home equity is bringing borrowers back into the mix that were previously shut out in 2009, 2010, 2011, because they were thinking, hey, I don't have equity in my house, so I'm not even going to attempt to refinance or purchase. I don't have the down payment. But in the case of a refinance, now they're saying, well, I've gotten some of that equity back. That's been restored. So now the only limiter is my FICO, and I'll take a shot at this because I'm stuck at this loan at 6.25% or whatever it may be. Maybe now is the time to get it and try. When I pulled their FICO, I revealed that, okay, you're under 700, where I remember 2008, 2009, every loan I pulled, it seemed like I was getting an 800 FICO score because they knew they were the only people that could get a loan.
It's interesting that the article you brought in here, which got started the conversation, says number of Bay Area homes with underwater mortgages tumbles. I noticed that was the article in the San Jose Mercury News.
Right.
So what's happening in San Jose right now in Silicon Valley?
Yeah.
Home prices are skyrocketing.
Yeah.
And it's true. The number of homes, the number of people with homes who are strategically or technically underwater. I mean, they may not actually owe more than it's worth, but there's not enough equity for them to actually sell the
Right.
property and have any cash to be able to buy the next home. So there's still a lot of people locked in, and I know that that's really that's contributing. The remaining homes that are still remaining under effectively underwater and
Right.
locked out. It's really affecting the amount of inventory.
Yeah, it is, and to get to Edward's point about the FICOs, are banks being are they more accommodative of a lower FICO score? We have a number of investors in programs, and I think what's very, very heartening is to see that the lending industry, at least at RPM, we are taking on new product that is trying to do make sense lending. So if your FICO is a little compromised, let's say you got a 680 FICO score, which is not all that bad to be quite honest, but you have a strong loan to value, then we're looking at making that loan. Because the appetite on the secondary market, whether that's Wall Street or in other places, they are looking for yield. And I think they are realizing that the real estate market can be healthy and has been healthy over the near term, and they're looking to make those loans if they make sense. And that's encouraging.
If I got a FICO score of 320, will you give me enough money to buy a tent?
No, but I tell you what we will do. If you have a FICO score of 320, we will print that out and we will post it in our building, and everyone that walks by it will have. No, I'm kidding. I'm totally kidding.
Yeah,
We will not do that.
Please don't.
And if we do it, we'll black out the social.
So only black out the face and the name.
No, I'm kidding. We don't see a lot of 320s at RPM, but if you got one, and you want to take a shot at it, you will make somebody,
You'd have
a
to
good
try
chuckle.
really
You would.
hard.
In fact, you wouldn't even probably give them a loan.
I think I saw.
Probably not.
I think I saw a 4 once before the downturn, and even that was like knock you back in your seat, kind of. I've never seen it.
They should be proud of that. That's hard to do.
It takes a lot of work. You got to piss a lot of people off to get a 400 FICO.
Get a loan and immediately don't pay anything.
Well, certainly with the refi boom essentially done and over with, and we've had multiple cycles of refinance booms over the last 10 years, but no one really believes the price, we'll ever see 3%, maybe not in our lifetimes again.
Right.
So the banks are going to have to do something to make up for the fact that
It's not rate driven.
Yeah. So really, it's the ability to repay is going to be a big factor in loans going forward. But I think they're going to probably relax FICO scores, and in fact, it may surprise us as to how low they'll start to approve loans in terms of FICO scores, as long as you've got the ability to repay.
Good point.
You've got the income.
Good point,
If you
because
document your income, it's
FICO
stronger than a FICO score.
Yeah, FICO is not a factor in ability to repay.
Yeah.
I mean, well, the history of repayment is, but the actual score itself, there is nothing in Dodd-Frank that says you need to have a certain number to get a loan.
That's exactly right, and that's.
I don't think they will either because it's
because-
a private company.
Discrimination would be, yeah.
Sure, and things change. Your
Right.
FICO goes down for one reason or
Right.
another. Gentlemen, thank you very much.
You're very welcome.
It was a very interesting guest we had in the beginning. Okay, here are
Thanks
our,
for good radio.
Yeah, that's for sure. Okay, here's our thought. If you didn't catch it, then you'll have to listen on the podcast, Best of Investing. Thoughts for the day. In 2009, ABC News found a total of 119 different spellings of the Libyan dictator Muammar Gaddafi.
Yeah.
Now, he should have changed his name to John Smith.
My favorite was Gaddafi Duck.
Gaddafi, I like that. Or we used to call, remember in 1979, the Ayatollah Cockamamie?
Yes.
Okay, and a Rubik's Cube has 43 quintillion possible configurations. No wonder I still haven't figured it out.
Including the one where you pull it apart and put it back together?
No, you know what I do? I just paint all the cubes the same color, and I go,
I think
won.
I've gotten that done once.
I couldn't figure it out. Since 1983, I still haven't figured it out. Okay, tune in next week. Then I try it every night. Tune in next week to the Best of Investing. We're giving away 9 more free vacations for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown, wishing you the best of investing. So long.